The stock market is crashing, and everyone's saying you should get out now before Trump triggers a full-blown recession. That's exactly what the mainstream media wants you to believe. Headlines scream disaster, social media is in a frenzy, and everyone's asking the same question. Should I sell now before it gets worse? But there's more to this story than meets the eye. If you've followed me for a while, you know I'm a serious investor obsessed with the stock market. And since so many of you have started investing because of my videos, I feel responsible for giving you my honest take on the situation. So, before you panic, let's take a step back and look at the bigger picture together. Every market crash has a cause, and this one is no different. It's not random. There are three major triggers driving this, and they all tie back to one man, Donald Trump. Now, before anyone jumps to conclusions, this isn't about politics. I'm not here to take sides. I'm just a British investor looking in, focused on how this impacts people like you and me. Let's break down the three biggest triggers behind this crash, why they matter, and what you can actually do to benefit from the chaos. Trigger 1: Trump's trade war. Trump has always pitched himself as the ultimate dealmaker, the guy who fights for American jobs and plays hardball with other countries. But the trade wars he started could raise your grocery bill and even trigger a recession. The last time the US tried this, it helped spark the Great Depression, wiping out jobs and wrecking the economy. Now, it feels like history might be repeating itself. Stocks are crashing, prices are rising, and if this spirals, it won't just hurt Wall Street, it'll hit you where it matters most, your bank account. Let's go back to 1930, when the US government introduced massive tariffs, taxes on imported goods, to protect American businesses from foreign competition. It was called the Smoot-Hawley Tariff Act, and it became one of the worst economic mistakes in history. At first, it seemed like a good idea. American companies wouldn't have to compete with cheap imports, and more products would be made in the USA. But the problem? Other countries retaliated. Nations that once traded with the US raised their own tariffs, making it harder for American businesses to sell products overseas. Trade slowed to a crawl. Businesses collapsed. Millions lost their jobs. Instead of fixing the economy, it turned a regular recession into the Great Depression, one of the worst financial crises ever. Fast forward nearly a century, and Trump has brought tariffs back in a big way. In February 2025, he announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. Canada fired back with a 25% tariff on American imports. Then, Ontario added a 25% surcharge on electricity exports to US states like New York, Michigan, and Minnesota. That move, honestly, was more symbolic and wouldn't have seriously hurt the US economy. But Trump didn't hold back. Instead of brushing it off, he escalated things, increasing tariffs on Canadian steel and aluminum to 50%. That wasn't just for show. It hit Canada's manufacturing industry hard, and it also drove up steel prices for American businesses that rely on imports. So why am I telling you all this? Because this is where the real problem starts. Tariffs sound good on paper. They're supposed to punish foreign businesses and encourage more American-made products. But in reality, they hurt regular people more than anyone else. As a business owner who manufactures products and imports from China myself, I can tell you, when businesses are forced to pay more for materials, they don't just absorb the cost. They pass it on to customers. That means higher prices on cars, appliances, and electronics. Food gets more expensive because supply chains are disrupted. Essentials cost more, and household budgets get stretched even thinner. Meanwhile, other countries aren't just sitting around while Trump raises tariffs. They're forming new alliances to trade without the US leading the charge as China, along with the BRICS alliance, Brazil, Russia, India, South Africa, all working together to reduce dependence on American trade. The more the US isolates itself, the more other countries look elsewhere for business. So, what's my take as an experienced investor? If Trump goes all in on this trade war, history suggests it'll do more harm than good. Some industries might get a short-term boost, but the long-term damage, higher prices, weaker global ties, and a slowing US economy could far outweigh any benefits. But if I'm being completely honest, I don't think Trump actually wants high tariffs. Sounds crazy, right? But hear me out. At his core, Trump is a businessman and a deal-maker, just like me. That's why I believe he's using tariffs as a negotiation tactic, not as the end goal. So what does he really want? In my opinion, he's after free global trade, but on terms that favor the US. And if he pulls that off, it could pay off big time. The problem is, his approach is creating massive uncertainty. The constant backtracking, new tariffs, and mixed signals are spooking the stock market. And here's what every investor knows: markets hate unpredictability. If this drags on too long, it could shake investor confidence so badly that it triggers a recession. And even Trump's own administration admits that's a risk they're willing to take. Right now, the market isn't just reacting to the tariffs, it's reacting to the uncertainty about what comes next. And in investing, uncertainty is one of the biggest killers of confidence. The second trigger is Trump's position on NATO. He's repeatedly questioned the alliance's purpose, arguing the US shouldn't continue defending allies unless they pay more for their protection. While that might sound reasonable, pulling back US support could create a power vacuum that countries like Russia and China could exploit. And markets hate uncertainty. The moment investors sense global instability, panic sets in. A weakened NATO might embolden Russia to push further into Europe or spark new conflicts as countries adjust to a world without America as the global police force. More conflicts mean higher military spending, disrupted trade, and soaring energy prices, all of which could send markets tumbling. 3. Trump's alleged plan to crash the market. The third trigger is a bold theory that Trump might be deliberately crashing the stock market. Sounds crazy, right? But there's logic behind it. Trump has always hated high interest rates, calling them ridiculous, and he's frequently criticized the Federal Reserve for keeping them high. Now, while the Fed operates independently, its decisions depend on economic conditions. If the market crashes and a recession looms, the Fed must act, slashing rates to avoid a meltdown. But why would Trump want that? Because high rates slow the economy, businesses borrow less, stocks drop, and consumer spending shrinks. For Trump, who thrives on growth, that's unacceptable. More importantly, high rates make the government's $36.5 trillion debt insanely expensive, like maxing out a credit card with 10% interest. Imagine paying $3,650 annually just in interest on a $36,500 debt. But if rates drop to 3%, that interest falls to $1,095, saving over $2,500 yearly. Now scale that to trillions. Lower rates could save the government billions, even trillions, in interest. If Trump triggers this scenario, it could be one of the boldest financial plays in history. If this theory holds, we're not facing a long-term collapse, just a temporary shakeup before a rebound. How to benefit from a market crash. So, how do you benefit from this potential crash? First, understand market crashes aren't rare, they're a normal part of investing. Every few years, markets dip, the media screams it's over, but history proves otherwise. Every US market crash has eventually been followed by a recovery. The people who panic and sell lose. The ones who stay calm and invest wisely often come out on top. Here's what you can do. Step 1. Invest during the dip. Before investing, build a strong foundation, an emergency fund covering 3 to 6 months of expenses, and pay off high-interest debts above 8%. If you're ready, now could be the perfect time to start investing. Stocks are essentially on sale. In 2008, I kept investing at the bottom and saw my portfolio double within years, while my friends who panicked missed out. No one can time the bottom perfectly, but consistently investing during a downturn means buying assets at a discount. Apps like Trading 212 even offer free fractional shares worth up to £100 with the code Tilbury when you fund your account. Check the link in the description if you're interested. Step 2. Stay disciplined and think long-term. Market crashes follow cycles, corrections, 10 to 20% drops, bear markets, 20 to 40%, and rare full collapses, 40% plus. Historically, even the worst crashes are followed by major recoveries. Most beginners fail because of emotional decisions, selling during fear and buying during greed. Instead, stick to strategies like dollar-cost averaging, invest a fixed amount every month, no matter what the market is doing. This minimizes risk and builds long-term wealth. Step 3. Diversify your investments. Never put all your money in one asset. Diversification is your best defense. Spread investments across stocks, bonds, real estate, precious metals like gold, and even cryptocurrency. Consider dividend-paying stocks too, they provide income even when markets drop. Remember, market crashes aren't the end. If you stay informed, disciplined, and patient, you'll be the one capitalizing on opportunities while others panic. This isn't the time to fear, it's the time to prepare. The smart moves you make now could set you up for massive gains when the market rebounds. If you got value from this video, do me a favor, hit that like button, subscribe, and turn on the notification bell so you don't miss the next one.